Hello everyone, welcome back to my tutorials in mutual fund. And today we'll be talking more about the terminologies that you should be knowing as a mutual fund investor. And again, there are many things that you need to know when you get into complex investing. But today we are only going to talk about the basics that you need to know as an investor. AMC, or an asset management company. Consider AMC as a manufacturer of your mutual fund. But they not only manufacture the fund, but they also actually maintains your mutual fund. There are many AMCs in India, for example. One of the simplest example is ICICI Prudential. ICICI Prudential is an AMC that actually manufactures ICICI Prudential mutual funds. Tatas have an AMC. They produce any mutual fund that you see the name as Tata on it. When you're trying to invest your money, it is the AMC who actually takes your money and invests on your behalf. And they could make that investment on multiple asset classes underlying. They could either invest that in a stock market, they could either invest that money into another bond. It all depends on the theme of the particular mutual fund. AMCs employ very smart people who are qualified enough to do this activity. They are also known as fund houses, and it is very, very important that when you choose a mutual fund investment, you go with asset management companies that has a track record and also have a good reputation in the market. Because these are private entities and they are the ones whom you are trusting and parking your money on. So the quality of these companies are very, very important when you try to park your hard-earned money. Portfolio managers or PMs. In the previous slide, I spoke about AMCs who employ smart people to manage your money. And these are the portfolio managers. They are the ones who actually takes care of your money and makes investments on your behalf. They make decisions in such a way that the returns are generated maximum for your mutual fund, for the fund that you're investing in. Likewise, the reputation of the AMCs, the reputation of the portfolio manager is also very, very important when you pick a fund. But in a normal case, if you're going with a reputed AMC, almost every portfolio managers under that AMC will be very well qualified professionals. You really don't need to worry much. But if you're a person who wants to be extra cautious, going through the credibility of the portfolio managers are also very important to make a decision whether you have to invest in this particular fund or not. And every fund might or might not be managed by one or more portfolio managers. Units. When you're trying to park your money with any mutual fund, what are you getting in return, right? A simple example is fixed deposit. When you're trying to invest money in a fixed deposit in any bank, the bank is liable to give you a certificate saying that you have parked this much number of money, this is going to be your interest, and this is your maturity date, etc., etc. You are getting the fixed deposit in return. And whenever you wanted to break the fixed deposit, you have to go to the bank, show the FD certificate, and using the FD certificate, they actually break your FD and credit the money back to your account. You can consider units also as something similar. This is what you're getting in return when you're trying to park your money in a mutual fund. A unit can be also called as a share. For example, let's say you're trying to park 10,000 rupees in ABC fund. The cost of one share is 10 rupees. When you are investing 10,000 into ABC fund, the company will give you in return 1,000 units of ABC fund. Now, based on several factors, the cost of this fund will go up or down, which is tightly linked to the market performance. So let's say today you bought something for 10 rupees and you have 10,000 of it. That makes you 10,000 rupees. A month from now, the market performs really well and the value of your fund goes above from 10 rupees to 10.5 rupees. Now that 0.5 is your profit per share. Now on the second month, you are in need of money and you're trying to redeem the mutual fund. You go and place a sell order with the AMC, and the AMC will take that 10,000 units, 1,000 units from you and return the current value of those units, current value of those units. And what that means is you bought it for 10 rupees per share, 1,000 shares or unit, and now you're getting in return the same 10,000 units for 10.5 rupees, which means you made a 500 rupees profit. Net asset value. Net asset value is nothing but the cost or the price of one share in a mutual fund or a unit, right? Or one unit in a mutual fund. Like in the previous example, you invested 10,000, you got 1,000 units back, and one unit cost 10 rupees. That 10 rupees is known as net asset value. Net asset values are calculated using a very complex formula. We don't have to get into those details, but based on how the underlying asset of the mutual fund works, the value of the NAV changes. For example, if the mutual fund is investing internally to the Sensex. Sensex, Sensex is sensitive index, and this is an index that we all rely upon in India to assess how the market performs. Let's not get into the details of what Sensex is. But let's assume that your mutual fund is tightly coupled with the Sensex, and the value of your fund or the investments or the underlying assets of your fund is tightly linked to Sensex. So what happens? On a daily basis, the Sensex moves up or down based on several factors. And if your mutual fund is truly tracking the Sensex, when the Sensex goes up, the value of your NAV goes up. When the Sensex goes down, the value of your NAV goes down. Now, this pricing factor changes on a daily basis. So every day, end of the day, the value or the price of your mutual fund changes. So in India today, how it works is, again, this timing keeps on changing. If you are able to buy any mutual fund on the current day before 2 p.m., you will get the fund for the current day's NAV. And what that means is, let's say, on a fine day morning, you woke up, you saw that the markets are falling and the value is at, let's say the Sensex fell by 2%. And usually good investors, they try to leverage the market conditions. You trying to buy things when the prices are low so that you can take an advantage when the prices goes up. So let's say today you woke up, you saw the markets are falling, and you have a gut feeling that this is how it is going to be today. The market won't recover today, and you make a decision to invest, let's say 1 lakh, so that you can get the same mutual fund shares for a lesser price. If you're able to make that buy transaction before, or place the buy transaction before 2 p.m., you will get the fund for the price of the same day. If any transactions are being submitted or placed after 2 p.m., you will be given, or the NAV price at which you will be buying your mutual fund will be of the next day's price. So this is how the algorithm works. Again, this 2 p.m. thing keeps on changing, so you need to keep a track on what You need to keep a track on the news to understand what is the current cutoff timing. During the COVID pandemic, I remember that the cutoff timing was changed as 12 p.m. So this keeps on changing, by the way. New fund offering. So new fund offering is very similar to IPOs. And if you're not familiar with IPOs, IPOs is its first time. IPOs is like the first time sale of a share. So let's say I'm an ABC AMC company, and I decided to launch a technology fund. And the theme of my fund is I'm going to only invest on technology companies across the globe. And this new fund idea, I'm going to implement, and I'm going to go to my investors and ask for money, investors like you and me. That launch process is known as NFO, or new fund offering. And that is the time, usually when the fund house creates the fund and goes to the general public and asks for money. And based on several factors, when let's say the theme of the fund is sounding exciting to you, or let's say, that this AMC company is very good, has very good reputation, and you trust them very well. On top of it, you also know the portfolio managers. They are actually superstars in the market. So you might decide to buy that fund and you go and invest your money. Similarly, they will pool in the money. And by the way, when you invest the money itself, they will say that I'm going to sell or launch this fund at a cost of 10 rupees per share. Usually, 90% of the cases when a new fund offering happens, the cost of one share will be 10 rupees. That could change, but usually this is what I have seen. So you invest, let's say 10,000, and you will be getting 1,000 rupees back, 1,000 units back, and there'll be again a start date and end date. Between this period, you can go and invest your money, and once the end date is done, it will take close to anywhere between 3 to 4 weeks for the fund house to launch the fund to the secondary market. And post that, based upon the type of the fund, you can buy or sell the same fund on any day. The advantage of a new fund offering is, if you are participating in the new fund offering, you will be getting one share at 10 rupees or the launch price. It's same with any other ideas, right? If you're planning to buy an under construction apartment, you will be getting the apartment. You will getting a square feet price which is lower than the market price. It's the same idea. We'll get into the details of new fund, whether it is a good idea to be invested in a new fund offering or not in a later session. But for now, just understand that this is how a fund goes live in the market. Again, there are multiple types of fund. I'm not getting into the details. For example, there are open-ended funds, there are closed-ended funds, and based on that, you can buy or sell anytime during the life of the fund, or there are some lock-in periods. But I'm not going to get into those details now because it will get too complex for an average investor. Entry load. So this idea is not there anymore in India, by the way. Entry loads are nothing but this is a fee that the fund house will charge on you when you're trying to invest in any mutual fund. For example, let's say you are going to invest 10,000 rupees on ABC fund. The ABC fund will charge X percentage of money for you to get invested in that fund. And they normally do that because there are some expenses for the fund in terms of setting up your account, investing that money, transaction cost, etc., etc. They also need to pay their portfolio managers, right? And their pays are really, really handsome. So that's why the fund houses used to charge entry loads. But in 2009, the SEBI banned entry load idea in India, and they said, beginning this date, no longer we support entry loads on mutual fund, which means the investors can invest in any mutual fund for free. But there's a catch. We'll get to that later. Exit load. Similar to entry load, exit load is again a fee that you need to pay back to the fund house when you're trying to redeem your units for cash. Even though entry loads are banned, exit loads still exist. And the exit load structure differs based on the type of fund you are into, the type of the asset company. Based on several factors, the exit load percentage changes. I have seen the exit load up to 2% in certain scenarios. For example, there is a fund called Tata Technology Fund. It's a very good fund, by the way. It basically invests in a lot of niche technology companies in India, and they produce superior returns. So if you're investing in Tata Technology Fund, and let's say you invested 1 lakh, and in 6 months you're redeeming the cash, redeeming the money. They charge up to, I believe, 2% just in case if you're redeeming the cash within 1 year or 365 days. Beyond 1 year, if you redeem, again, the exit load percentage reduces, or in some cases, the fund house will say that I don't expect any exit load if you're investing for more than 1 year. So consider this as a fee. But to be very honest, unless otherwise you are too picky, you have to get into these details. But if you are a person who wants to, have a peaceful investment experience, then don't get into too much of details. Just focus on how much returns you are producing on your money. When you get into the investment, especially into mutual funds, there are many different types of funds that you can invest into. Hybrid funds, large cap funds, mid cap funds, small cap funds, thematic funds, etc., etc. It's actually very difficult to get into those details, but I would like to throw in some of the basic types of funds so that you will get an idea on what you're getting into. So when I used to start invest in mutual funds, I used to notice a couple of things. When I search for a particular fund, for example, let's say I'm going to invest in Tata Technology Fund. I'm just giving a hypothetical example. I really don't know if this is true for the Tata Technology Fund itself, but in general, if you know an ABC fund and if you're trying to search for that fund to buy it, you can send different versions of the fund. One will say growth fund, the second will say dividend fund. I just wanted to explain what is the basic difference between both of them. So let's get into the details of the growth fund first. When your fund house is investing in underlying assets, in our example, let's say your fund house is investing on your behalf into technology companies in India like Tata, TCS, Wipro, Infosys, and HCL. Every quarter, these companies announce their quarterly results about how they are performing financially. Plus, they might or might not also announce how much dividend they are going to pay back per share. In a usual case, if you're a retail investor directly investing into these stocks, your account will get credited with those much of dividend income. But in case of an asset management company, the dividend actually gets paid out to the AMC's account. But technically, they don't own that money because they are leveraging the investors' money to invest in these stocks. So technically, they have to pass on that benefits back to the investors. This is where the growth fund idea comes into picture. Any earnings the fund generates in similar fashion, and this is again only one of the examples. There are many examples on earnings a fund can generate. In growth funds, the dividends or the earnings the fund is generating, which will be in millions of rupees, will be again reinvested in the fund, which means using that money, they will again try to buy or sell stocks within their portfolio so that overall the value of the fund grows. The second type of fund are dividend funds. In this based, like I mentioned, any earnings generated by the fund house is directly passed on to the investors. So based on the fund house's decision, the investors of the fund will get a periodical dividend income. They might or might not declare a dividend, but this is completely based on the fund house's discretion. I personally choose growth funds or dividend fund because, um, especially for people like us who are in middle age, the moment you get some income on your hand or returns on your hand, you tend to spend it. So my principle is not to invest on dividend fund, rather invest on growth funds. So the overall fund value actually grows. Direct mutual funds. Um, Again, this is again my own thought process. Like I mentioned in my first tutorial, I'm not an investment professional. I'm just sharing my own experience. Um, so use it at your own discretion. Um, there are two ways you can buy a mutual fund. Same like any good. You can directly go to the factory and buy it, or you can buy it from a distributor or through a broker. As simple as that. In case if you are directly buying it from the factory or the AMCs, that is called a direct mutual fund. And if you are not buying directly from the AMCs, and if you're buying it through any distributor or any broker, that is when your mutual fund will become a regular mutual fund. And there are pros and cons as well based on whom you're buying it from. Like in any theory, like in any transaction, if you're directly able to buy a good from the manufacturer, the price or the expenses will be low, right? Because if you're directly buying it from the manufacturer, um, the transportation cost is on you. You go to the factory and you buy it, and transporting the good is on you. But if you're buying it through a distributor or a broker, the brokers and the distributors will take a cut because they went to the factory, they took the pain of transporting it. And now when you're buying it from a distributor or a broker, they will definitely take a profit out of it. Similarly, in direct funds, if you're trying to buy it directly from an asset management company, the commissions they have to pass on to the brokers and the distributors will be negated. And that benefit will be passed on to you. But that doesn't mean that, you know, you can directly see the benefit, but these nuances of the expenses are actually adjusted in the NAV of the fund itself. So if you read the brochure of any mutual fund, you can see something called fund expense ratio. The fund expense ratio can anywhere between 1 to 5%. I have seen up to 5%. And this expense is actually considering all these different factors that are involved in a fund. And if you're buying through a broker or a distributor, most of the cases you will not be able to buy a direct mutual fund, which means the fund expense ratio will be on the higher side. Again, which is something that will be reflected on your NAV values. Whereas in a direct fund, since the fund expense ratios will be less, and for the same mutual fund, you can see a slightly different NAV value for a direct fund. But like I said, there are pros and cons. If you are very picky on pricing, if you are too much picky on how much money you are going to spend on a mutual fund or how much returns you're going to generate, if you're too picky on it, maybe direct fund is the best case for you. But for a person like me, I don't have time to, spend too much on managing my investments. So I always prefer to open an account with a broker or a distributor to buy the mutual funds. I'll give you an example. So let's say you decided to buy direct funds from Tata and from ICICI Prudential. The challenge here is you as an investor will have to open an account separately with each of the fund houses. And that is a really, really painful process. Trust me. You have to fill in all the details, your financial details. You have to fill in the details like your cancelled check, your bank account details. And this process has to be repeated each time you are trying to open an account with any fund house. Now, the real challenge is not that. You also have to document separately on which all fund houses you have opened an account and how much money you have parked in each of these fund houses, right? And if you need to make a change in your investments, let's say systematic investment plans, you need to make a change to your systematic investment plans. Again, you need to go to all these different fund houses website and make those changes. So management becomes a little bit cumbersome in case if you're going with a direct mutual fund. Whereas if you're going to a broker or a distributor, they will provide you an interface through which you can efficiently manage the way you are going to invest in your mutual funds. So a person like me who is usually busy with day-to-day work, I cannot spend more than 10 to 15 minutes on managing my investments. So I prefer to do the investments through a broker's interface so that I can easily manage my investments or make adjustment to my investments. Again, this is my perspective. Based on your situation, you can make a choice between a direct mutual fund or a regular mutual fund. It's totally up to you. And in my tutorials, I'll be mostly referring to ICICI Direct, which is the broker I am registered with. I'm using it only because I've been used to the interface. I like the interface, and I'm a customer with ICICI Direct for the last 17 years. So most of my discussion in the tutorials will be based on ICICI Direct's interface. Well, with that, I've come to a conclusion on all the basic terminologies I wanted you to be aware about. I'm pretty sure there are many more. If you want to know more about any of specific terminologies, please put in a comment in my YouTube channel. I'll try to address it as much as possible. If you really like the video, please like it and subscribe to my YouTube channel. The next session, let's start getting into some of the basic investments strategies. Thank you.